an ICT charter trader who made over $1 million in profits from the markets by the age of 18.
ICT mentioned this multiple times in his lectures, but within his logo there are numbers which are visible. And once you recognize what those numbers are, you know what key levels price is going to refer to. Everyone is overlooking something which he has hidden in plain sight. And that right there is, in my opinion, what changed the game.
He goes by Zeussy, and interestingly, his strategy gives more importance to time than price itself. And in this episode, we explore his A+ setups and how he connects his key levels to his key time windows.
You're familiar with SMT. A lot of people got introduced to it as smart money tool, smart money technique. However, SMT stands for something completely else. Smart money time. So SMT is by far the most crucial element when it comes to my trading approach. Because what SMT is signaling, even within the ICT trading space, a lot of people struggle because they just chase that pattern of that bearish breaker formation and they short it, and they're then like, oh, why am I getting stopped out right here? What I refer to is something which I call the reversal sequence. Very fixed and objective steps which need to occur in the right order. If I cannot define the smart money reversal, there's no trade.
I've seen the hate, I've seen the love. I don't have a position, but I know a lot of people, they just have a prejudice. They're like, whatever someone says about ICT, they're probably a cult, they're a fan, they're whatever. They don't know what's really going on. So I think you'll be in a good position to really shed some light on, okay, what are you seeing that the outside people are not?
There are a few key things which I want to share on this podcast as well, which are the following.
Ladies and gents, welcome back to another episode. I'm joined by Zeussy, who no one knows until today, named Frank. Frank, thank you very much for joining us today. So this is going to be a fiery episode, I can tell, because we've been speaking now a little bit off camera. And you're an ICT trader, and already alarm bells are going off for people. But I've spoken to a lot of ICT traders. I think at least a third of the guests on the show I've had have been derivatives of ICT. But it seems like you're doing ICT with your own either spin or a lot deeper. So I want to start to unpack with you to have freedom where you want to take it. What do you think it is within ICT that is aside from the cult, and what is the deep stuff that you are like, this is where the magic happens?
Well, first of all, thank you, Wakar, for having me on the podcast. I really appreciate you for inviting me over. Bro. But when it comes to your question, what is truly behind ICT? I believe the true reason behind ICT and why it's so popular nowadays is because a lot of traders, they're struggling with objectifying their own trading approach. So they come to ICT and all of a sudden it becomes clear based upon a time and price perspective why the markets are moving the way that they're doing, but more importantly, when they're moving the way that they're doing. So that is where ICT bridges the gap between, okay, someone that comes out here in the trading space and just learns a price pattern, and someone that comes out here and actually knows when that price pattern is going to work and when not.
You may have seen, I don't know if you're familiar with any of my trading style, but I talk a lot about smart money concept traps. And the idea being that a very basic smart money trader or very basic ICT trader, they'll look at equal highs out of context, not even in a POI, just some equal highs. They'll see a sweep high and they'll look to sell that imbalance, fair value gap, whatever. And I've just seen that pattern getting printed. You see the equal highs, you see the sweep, you see the small rejection, price comes back up, and instead of mitigating, it just takes it out for a few pips and then drops. And I call that an inducement of a smart money trap. How are you reading this? Because this is something that happens pretty much daily, and I'm sure you've seen a signature of it. How do you understand that, and where do you differentiate from a typical introductory smart money trader who's trading that pattern versus yourself, who is probably allowing more context and storytelling?
Well, first of all, it's important to understand that the price pattern itself of relatively equal highs or relatively equal lows being ran doesn't mean anything. And the reason why is because that's simply a price pattern. Yes, it's simply something that's occurring throughout the days. It occurs a lot. And that is one of the things which I'm a big believer in. And that's why I believe that even within the ICT trading space, a lot of people struggle, is because they just chase that pattern. They chase that pattern of that bearish breaker formation and they short it, and they're then like, oh, why am I getting stopped out right here? Why does it make one more move higher before the real reversal takes place? What I refer to is something which I call the reversal sequence. And what the reversal sequence is these very fixed and objective steps which need to occur in the right order. And if they are not occurring in the right order or not at the right time, it means that the SMR, the smart money reversal, is not in. So what my focus is on all the time is recognizing what is the smart money reversal. If I cannot define the smart money reversal, there's no trade. So when it comes back to your question, it's important to note that if you just purely look for that price pattern, you're never going to find the consistency that you're looking for. The reason why is because it's simply a price pattern. And if you try and trade every single breaker or fair value gap that forms throughout the day, you're going to struggle. Why are you going to struggle? Because as time has matured and as time has passed, what happened is that because there were more traders that began trading this way, what happens is, hey, it gets recognized.
How would you differentiate between someone that is trading with a narrative or context or understanding the language of price versus someone who's a pattern trader? Now, let me develop this. So you have, let's say, level 1 SMC trader who's just like, any equal high is getting swept, so I'm going to try and sell it. And then the level 2 is like, no, I'm going to do it inside of a point of interest. Number 3 will be like, I'm going to do it inside of a point of interest in London Open. The next one is like, only if it has a break of structure. And then you add these rules. But if you do still zoom out, even the guy who's doing all 5 steps, let's say, in the end, it's kind of a pattern. He's just added more rules to his pattern. How do you take someone that is pattern trading, no matter how in-depth the pattern is, it's still maybe a correlation versus some sort of, okay, I'm understanding the true meaning behind it. And how do you make sure you're in this category and not that one?
Mm-hmm. Well, it's important to note that unless a trader who trades this way is purely paying attention to specific times and specific prices, it's not objective.
Let's break that down, because I know in your car, I just saw it, the logo is everywhere, it's time and price. So break that down, why you're such a firm believer specifically in time.
So first of all, it's important to note that all these different price patterns that were created by ICT, mad respect, shout out to Michael as well for that, because what he has created in terms of a language is insane, where he created a language around the real language which is taking place all the time by central banks, by big entities, etc., that control the delivery of price. It's insane how he created a language around the real language without spilling too much of it. But
okay,
we'll get into that later.
Let's get into that, because to be honest, my position is actually neutral. I've seen the hate, I've seen the love. I don't have a position, but I know a lot of people, typically speaking, they just have a prejudice. They're like, whatever someone says about ICT, they're probably a cult, they're a fan, they're whatever. They don't know what's really going on. So I think you'll be in a good position to really shed some light on, okay, what is someone that has seen the realities of ICT, is not just clouded by the mirage of ICT, but has actually seen it himself and traded it himself. What are you seeing that the outside people are not?
So when it comes to the majority of ICT traders, they get introduced to a PDA race. And the PDA race are the language which Michael has created to explain why the market is doing what it's doing. If you purely focus on PDA race, I'm 130% confident that you're able to gauge order flow, so read the markets already way better than if you wouldn't be paying attention to them.
Okay.
However, where these people all struggle is that they don't realize that the PDA race themselves are not the reason why price is going up and down and sideways, whatever. There's a deeper meaning behind each specific PDA array.
PDA array, if I'm not mistaken, is just premium discount.
Premium and discount array.
And therefore, there's a lot of logic in it that price generally retraces more than 50%. So therefore, selling in premium, buying in discount. It seems to me it's a very loose thing. It's not an exact science. It's just buy above 50%. Buy below 50, sell above 50%. How can you take that deeper?
Well, first of all, it's important to note that the PD array itself, I'm going to repeat myself because it's so important that the viewer understands this, a PD array itself doesn't mean anything. And the reason why it doesn't mean anything is because, okay, you need to have the right narrative in play. But even when you say that, it comes back to what you just said. Okay, you can have these steps which you outlined of, okay, price needs to be from a point of interest, then that displacement lag has to take place, that break of market structure whatsoever. It's still subjective, because how do you know the point of interest? How do you know the level that prices are going to turn around from? And that is where there's an objective logic in play, which ICT does not teach, but which he actively uses, where he uses these very specific price levels each freaking day, yes, and when price gets to those levels, he's beginning to count time, and he's beginning to pay attention to, okay, is right now that reversal sequence in play? And when he sees all these different steps in play, that is when he knows that, for example, let's take a bullish example, right? Because Nasdaq is at the time of this recording nearing new all-time highs. A lot of people are caught off guard because of what happened over the course of these past couple of weeks or months even, where we had trade wars, where we had real wars taking place in the Middle East, all of that crazy stuff, right? How is it possible that within such a short period of time, a major drop lower took place, followed by a massive run higher? How is that possible? And that right there is something which I want to touch on, because when you think about it, right, there's a reason why certain narratives get pushed in the media. There's a reason why certain ideas get thrown around on social media. what gets pushed around social media is all under control. There are entities who literally control the spread of information. And when you take that a step deeper and you begin to look at the markets, you begin to realize, hey, wait a minute, what if certain narratives gets pushed when it's aligned with smart money's agenda?
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry. And in the last year, they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
Did you see the recent things when this tariff situation drop happened and there's a V-recovery? And on the days of the initial recovery, Trump is in the White House with his buddies and he's like, he made 900 million, he made 50, he made $1 billion, whatever. And they're laughing about it. And then he just tweets prior saying, now's a good time to buy. I think that's the only reason he did that is to cover his ass and be like, okay, well, I didn't insider trading because I publicly tweeted about it. But I think that's a very evident example of what's probably happening below the surface more often.
But I want to share something with you, Akar, and with all the viewers watching this now. I see within the charts where these high-frequency trading algorithms, which are being utilized by these bigger entities to fill those huge positions, because they can't just go on the open market and fill hundreds of millions of Nasdaq or whatever, right? They need to make sure that that order gets filled around a specific price during a window of time. I see that within the charts. So every single news swing which occurs, where there's a news announcement and boom, price heavily reacts to that, it's already visible before the news comes out. And that's the perspective that I've gained over the years, where instead of reacting to what's happening in the world, I'm actually anticipating events to take place in the world. So my analysis throughout what happened in April was, hey, we're manipulating towards the downside with the fear of what was taking place in the world when it comes to the trade wars, where there was this crazy day where Trump just announced a crazy list of tariffs on a lot of countries. The markets plunged. It was like as if the world was coming crashing down, right? That's how it was being pushed around in media and such. That continued throughout the first few weeks of April. But then throughout the third week of April, yes, what happened was that all of a sudden, technically speaking, I saw the signs of a reversal taking place. So that's that reversal sequence. And now we're not speaking about an intraday chart. We're not speaking about a lower time frame chart. Now we're speaking about a huge price swing, a quarterly swing, yes? It's the same sequence of events that I'm looking for based upon time and price. The only difference there is the following. The only difference is the duration of the time cycles, which I'm referring to from start to finish, versus the price ranges, meaning the price ranges are way larger that I'm referring to. And because that is fractal, yes, I'm using the same approach when I'm trading, for example, a 15-second chart, 1-minute chart of Nasdaq, versus when I'm participating in a swing which is going to take place over the upcoming months. Do you understand? And one thing there, yes? Sorry to cut you off.
Of course.
But one thing which is important to note there is that when we go back to that belief that it's a rigged world, and there's nothing you can say that's like, oh, you know, it's supply and demand, or it's random, it's not programmed, whatever. I'm 130% convinced, based on that what I've seen for years now within the charts, that it's a rigged game, yes, based on time and price, because that is what these algorithms are referring to, yes. When you take that deeper and you begin to pay attention to the fact that, okay, we see such a big news manipulation taking place with the trade wars, and then all of a sudden, once within the charts it became obvious that on the 21st of April, the absolute bottom would form on the American markets, all of a sudden, what came out, hey, this country, for example, America, China, where there's a huge trade war going on, at some point I believe there was a tariff of 150% or something, we're going to cool it down, we're going to slow it down. Isn't it interesting how, technically speaking, it was already obvious that smart money was positioned long? Do you understand what I'm getting at? And that then the narrative gets pushed.
Narrative comes after.
Exactly.
I'm very interested. So I've got 1,000,001 questions. So let's see how long this episode goes. But there's a lot of directions I want to take it. First of all, I just want to start off with, you mentioning time and price, and it seems like they're heavily interlinked. Do you give one a priority over another? Let's say, does price come first, meaning am I in a key level, or does time come first and then you just wherever price happens to be?
It's always time first. It's time then price. So I don't look at it from time and price. It's time, then price.
And why would you say time is more important than where price is?
Because what happens is that at specific times of the day or of the week or of the month or of the quarter or of the year, there are opportunities which take place, yes? But what that means is that only throughout those windows of times, what you will see is manipulation being taken place. If I do not see manipulation when I anticipate manipulation and it occurs at the most random time of the day, I don't care. Why not? Because I want it to happen, or in fact, I need it to happen during that key window of time. And when price then manipulates into that key level, which I'm anchoring it off, that is when I know, okay, I can see the sequence as it's occurring. So I can recognize early on, hey, this is the plan that smart money is following today.
People that I need to explore with you in a moment, I will, but people that I see that are trading time a lot, especially those that are having, let's say, multiple windows of time, multiple moments of time that mean something to them. In my case, because I'm trading Forex EUGU, I'm doing the London Open and I have a New York window. So I have 2 hours a day. Now, the way I trade because I see it, not because I truly know why it's happening. And I'll be honest here, if someone's asked me, why does these things happen at this time? I don't know the answer. I've just seen it a million times, so I do it. But if I am to speculate on why, I would say, well, if I take 24 hours out of the day, Asia range is going to have a lower probability. It's just a probability thing. End of London is going to have a lower probability because there's no time left for the movement to happen. So the key windows that I've found just happen to be refined probabilistic zones, maybe not necessarily wise. So when I see someone that has, let's say, 5, 10 moments of time in a day that they're interested in, it's like someone that has like 10 support levels and price happens to bounce on one. It's like when you have 10 things on the screen, something's going to happen on one of them. How can you say to someone that with the time sequences, it's not the case of I have multiple lines, something happens on one of them versus I can actually make it a sequence and map out a journey? Is that something
yes, absolutely.
To an extent you're doing?
So what this all has to do with is accumulation, manipulation, and distribution. And my focus is on recognizing the manipulation because when I recognize the manipulation, I can trade the distribution afterwards. So if we take it back to that example which we just discussed of that huge price swing which occurred on the Nasdaq, what happened is this second quarter, we opened up and we dropped lower. We manipulated towards the downside, taking out a previous time cycle low. And I'm sure we'll dive deeper into time cycles as well, because if there's one thing which I really want the viewer to take away from this lecture is the importance of time, or from this podcast. I'm used to saying lecture, of course. But what's important to note is that the price pattern itself, it doesn't mean anything. But once you start paying attention to time cycles, all of a sudden everything becomes clear in price. So what I wait for is if I'm bullish, an open low into a specific key level, which is both based on a previous XL, so a previous time cycle low, previous year low in this example, into a key price level, so literally key price level, and that is when I'm beginning to look for that reversal sequence. And
what is key price level for you? Is it just zones of liquidity, or there's many categories of key levels?
Liquidity plays a huge part in it, yes.
Let's explore that.
Think about it this way. Yes. If smart money wants to buy a huge position, yes, they need a lot of sellers to step into the marketplace. They need a lot of selling interest. Yes. How do they make sure that there's a lot of selling interest for them to fill their positions? Yes. What they do is they target old lows. Why do they target those old lows? Because they know that below those old lows, a lot of buyers have placed their stop losses from a support perspective. However, by dropping the market lower, they're also doing something else. And they're inducing people that have no clue behind why the market is moving the way it's moving, and they're just reacting to what's happening in the world from the media and what the price is doing, etc. They see the market dropping and they think one thing. Why? Because why do they think that thing? What they think is shorting first of all. They think, I need to sell, I need to just get out now, or I need to fill shorts because it's going to run lower now. The reason why they think that way is because that's the human emotion which is being created there. It's being triggered, yes? So what IPDA, the interbank price delivery algorithm, is doing all the time is it's creating human emotion. And that's why it's so important that you're able to recognize where that manipulation is taking place. Because once you recognize, hey, a lot of people are now being pushed into this direction, I'm looking at that, and this is just how I've been thinking all my life up until this point, is literally just, okay, when everyone goes left, I go right. And that's just my natural way of viewing things. So when I see that taking place, and when I see everyone around me be fearful, and everyone is like, what's going on in the world? And they're like, I need to get out, I need to sell all my stocks whatsoever. I'm looking at that and recognizing, hey, you're being led to believe this. This is being triggered. And once I see technically that right there being confirmed, the rest is history.
One of the worst feelings as a trader is investing hundreds of dollars in a prop firm, earning your way to a payout just to get scammed by the prop firm. And I'm sure most of you are tired bouncing from website to website, not knowing who to trust, what are credible sources of information, and what are just marketing campaigns by these prop firms to trick you into spending your money with them. And that's why I'm proud to bring to you a partner of the show, that is Prop Firm Match. Now, Prop Firm Match is a complete and comprehensive, trusted comparison website of all of the prop firms in the industry, where you will have verified reviews of real traders who are actually customers of the prop firm. And inside the website, you have multiple filters so you can categorize the search based on your own trading style, based on what parameters are useful and preferred for you. But beyond just that, Prop Firm Match has the best discounts in the industry for each listed prop firms, so you can get everything that you need in one place. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry. So I call it a build up. I'm gathering you call it an accumulation, but it's just building liquidity and showing the narrative of others. So there's many forms where you could have, let's say, a support level forming. Now people are looking to buy. I'm waiting for that to get taken out. Other people might see a trend line. I'm waiting for that to get taken out. I might see a demand level from market structure. I'm waiting for that to get taken out. So I'm watching price deliver something. For the outsider, this might sound very either conspiracy or hippie. I don't know what it is, but I really believe in it because I see it all the time.
The thing is, Wakar, the reason why it's called a conspiracy is because people are nurtured in a certain way from their upbringing. Think about what kids are being fed in school. Think about the narrative that always gets pushed around the media and in the newspapers with regards to financial markets. And I need to be cautious with what I mention and don't mention on this because I don't want to get this shadow banned or blacklisted, whatever. Don't want to, put your channel at risk in that sense. But there are entities that are in control of the spread of information, to bring it back to what we started the podcast with. What gets taught in schools is richly controlled. What gets pushed around in the news is controlled. And once you start understanding that and you start blending that with financial markets and what you just outlined, you begin to see, hey, there's a direct combination between what's happening. And honestly, if someone still believes that it's all random and that's what's happening in the world, it's just, it just happens and that's it. And you have countries that,
with this side, I'm in a complete agreement, because legacy media is an arm of whatever we call them, but it's propaganda. And when you see recent current affairs that happened in the world, and you watch analyst videos online and you compare it to what you see on mainstream media, you can see there's a Western tint on it, or there's an agenda behind it. And if you watched Iranian news channels, there's probably another tint on there. So the spread of information and all of this, agendas, movies, music, schooling, is all there. But in the markets, because like I said, I trade things that I see, but I don't necessarily understand why. And I also don't always look for the why. I just see price builds up a liquidity and then takes it out and then goes. But if I'm to look into the why, this is where I get confused myself. Because if we are to say, okay, we had a support level, institutional buyers, are they getting in there? I don't know. Retail buyers, yes. But how much liquidity does a retail trader contribute? And this is where I really get confused. And I'm like, well, majority of retail traders are trading B-book brokers or B-book demo prop firms. So their liquidity is not even in the markets. So then when I see this trend line that is crystal clear, everybody can see it, just get wicked out and then goes in that direction. I'm seeing it as an inducement. I'm seeing it as somebody's liquidity got taken. But it's not the average viewer's liquidity. So whose liquidity is it? What is this liquidity in the market?
You'd be surprised how many retail traders are not touching prop firms. And I know that nowadays, it seems with social media that prop firms are the vehicle of traders. That's what every single retail trader uses, but it's not the case. And the reason why it of course looks that way on social media is because the prop firm's business is to get new customers in, and that's why they push it hard on social media. So people are led to believe, oh, prop firms are the only way. You'd be surprised how many traders are still just going into live brokers and trade from there. You understand what I'm getting at?
For sure. I speak to certain people in the US, and I'm speaking about prop firms so casually, and they're like, what is a prop firm?
Yeah.
Like, you've been trading for 30 years. How have you not, as you said, it's an emerging market.
Yeah.
It's big, but it's not industry wide.
I think honestly that when we're looking at it from that perspective, I think it's overhyped in the sense of, oh, it's not as if every single trader is now trading prop firms, because I know a lot of traders that are not trading prop firms.
Yep. Yeah, so back to the point of the liquidity though. Even if there is more retail traders that we're not considering prop firm, in the grand scheme of the trillions that flow through the market on a daily basis, the retail components, even if we consider only the ones that are A-book brokers and so forth, it's a drop in the ocean, surely. So then do we take it a level further and saying that these runs on liquidity are happening to institutional level too, to hedge funds and so forth, other algorithms, or are we implying it's only on the retail level?
No, it's not only on the retail level. So what a lot of people seem to believe is that you have this retail crowd and you have the institutional crowd, and they're fighting all the time. But what if in the institutional crowd you also have institutions which are fighting against each other? You understand what I'm getting at? They're constantly developing algorithms that are better than the other guy's algorithm. That's the whole game. Who's the quickest? And that's where high frequency trading algorithms come in play, of course. And there are a lot of interesting things that the viewers can look up on Google, YouTube, whatever, with regards to high frequency trading algorithms, because a lot of people don't even know what's going on. But it's no longer a game of, oh, you just buy and sell, that's it. No, it's about speed. Who is the quickest? It's a time game.
Back to the thing we mentioned earlier of the key levels, because that's where things connect for you. These key levels, let's say you have a support level that's formed on the 5-minute time frame and has 2 touches, and there's 1 touch today and 1 touch 4 hours ago. It's a support level, yes, but it's a very small support level, comparing it to another support level where it's on the weekly time frame and there's been 10 touches. Now, I would assume one has more impact than the other. So then when I categorize things myself, I just categorize it to minor, medium, and major. A major is going to be something like a daily time frame supply zone. Everybody can see it. Often it gets wicked out and then goes bearish anyway. The medium will be like 1 hour, 15 minutes, the middle time frames, intraday time frames. And then the minor is just a local M1 buildup. And therefore, for me, I categorize these levels because then I know a protocol. So if I just see a minor run of liquidity, that doesn't mean a trade for me. A major one connects and starts a trade, but a minor doesn't. But this is how I begin my key levels and then wait for the manipulation. How do you draw your key levels and how do you categorize them?
What's interesting is that you're referring to previous price action to determine your key levels.
Yes.
I don't. So I already know for next week what levels I'm going to be trading off. For next month, I already know what levels I'm going to be trading off. When
are you looking at psychological numbers or?
When Nasdaq trades into new all-time highs, which I believe it will soon, I already know what levels I'm going to be trading off. And psychological numbers indeed play a role in that, but I refer to other numbers as well. And yeah, when those numbers or those levels get reached at the right time to the minute, that's when that reversal sequence kicks off. And that's what ICT is looking at. So the majority of the audience thinks, oh, ICT is trading based on this IPDA array, based upon, oh, this rejection block or this order block, or he's trading based on this value gap or the breaker, whatsoever. But it's only appearing within the charts because of what I just outlined, where time and price are aligning. And when you recognize that time and price are aligning, everything else just takes place.
So price doesn't necessarily mean what happened on the left, because if you approach all-time highs, there's nothing on the left.
Voilà.
So are you able to do a reversal model and sell at some point at all-time highs?
I can. However, what for me the low resistance security run is, which is my main focus every single day, my focus is on determining what is the low resistance security run. When is spooling going to take place? And what spooling basically means is that what I'm of the opinion that, and this is a simple way to describe it, there are a lot of different algorithms which are in control of the delivery of price, but to keep it simple, IPDA. That's what ICT came out and he introduced IPDA, interbank price delivery algorithm. What IPDA does is that during specific windows of time, what it will do is it will spool. So let's say that we're bullish. Let's say that we're looking for higher prices. What IPDA will do is that it will spool towards the upside. And what happens throughout spooling is literally that every single key level is getting displaced through. So view it as if it's sort of climbing a ladder. It's climbing the ladder, or it's walking a staircase, better example. It's stepping up the staircase and it finds support at the level. And then it steps to the next staircase, it finds support and the next one and the next one, until it reaches its objective. It's drawing liquidity. And when it reaches that drawing liquidity, that's indeed when a short is present. But then the thing is, and this is the first step when it comes to my trading protocol, is literally higher time frame institutional order flow. What's the direction? So as Nasdaq is approaching new all-time highs, I would be foolish to think about shorts. Why? Because the higher time frame direction is bullish. To me, what makes more sense is waiting for one thing: an expansion higher followed by a retracement lower. What does that retracement lower induce? It induces a lot of sellers into the marketplace, because the human psychology is like, oh, what if this is the top? What if I can sell right here? I could make so much money if this is the top, right? Wrong. Why? Because IPDA is going to use you as liquidity. They place their stop losses above the retracement high, and what will happen is that a new expansion higher will take place. So that is my main model which I'm focusing on, yes? And that's the market maker buy model. Because on the lower time frames, inside of that expansion, retracement, expansion, you are going to see very clearly an original consolidation. And I'm using my fingers, by the way, so I'm sorry if you might be thinking, what's this guy doing? I'm trying to visually explain that what I'm outlining. Because the reason why it's so important to understand visually what's taking place is because then viewers can look at it. But once you start understanding the logic behind it, you're beginning to see, aha, this is what's taking place. So an original consolidation takes place. We see the market drop towards the downside into a key level. That's the sell side of the curve. That is where all those sellers are stepping in. Where do they place the stop loss? Above those smooth highs. So what will happen is that reversal will occur, and once the smart money reversal takes place, the buy side of the curve is going to take place, and that right there is going to be the low resistance liquidity run. So to come back to your question, you can short the original consolidation and ride the market lower, but it's going to be a very high resistance liquidity run with a lot of back and forth going. And for me personally, I want to be in and out of the markets, meaning I want to buy and I want price immediately to run.
Do you prefer continuation models or reversal models?
Very good question. It's honestly, on both sides, I can succeed. And the reason why is because on one hand, I can see that smaller manipulation cycle, that sell side of the curve followed by the buy side of the curve. But on the other hand, when we're speaking about that bigger price swing, which we were discussing about prior, that huge market maker buy model with Nasdaq now approaching new all-time highs, that swing trade, what's there taking place is a reversal. But when you zoom out on the grand scheme of things, when you compare to years of price action, it's the same framework. Expansion higher for a year straight, retracement lower, expansion higher. Do you understand what I'm getting at?
One thing that I want to bring this down to is something tangible. What I mean by this is frameworks of what is ordinary and what is achievable. Because a lot of people get caught up in, okay, well, if I master the algorithm or I master these concepts, then I'm on a one-way ticket to financial freedom, let's say. But as we all know, everyone has a win rate, everyone has risk-reward trade frequency. So if you can give me some numbers of what is an ordinary period of time for you in terms of win rate, risk-reward on an average trade frequency, how often can you get in, and your, let's say, usual rate of return.
Okay. So when it comes to any particular week or month, what are we speaking about? A quarter?
Let's do on an average month.
Okay.
I think that's a good amount of time.
An average month for me personally is every single month what I'm aiming for is I'm aiming for about 15 to 20%. That's my target, yes? But that's on the aggressive account, yes? So that's on the day trading account where I'm just risking 1% and I'm able... Sometimes I have literally weeks where I'm able to return that. Why? Because what I do is I pyramid into positions. So whenever I find a trade, and I see, hey, I'm aligned, so I get in at a super low price in the bullish market. What I'm doing is I'm adding, and I'm adding, and I'm adding, and I'm adding. And what's happening is that 1 to 3 or 1 to 4 trade setup, if you put the risk to reward to, is all of a sudden increasing significantly in its reward whilst maintaining the same risk profile.
So you only enter an additional position when the first one is break even. So therefore the risk is only moved. It's not additional risk.
Okay, so when it comes to pyramiding, there's a very objective way to do it, and that's the following. When it comes to pyramiding, and the viewer needs to know a bit about market maker models to understand this, but I'm going to try and keep it as simple as possible. Let's say that I enter at the first entry opportunity in a market maker buy model. This is referred to as the low risk buy. The moment that low risk buy indeed gets confirmed and I see the market displays in my favor, so it runs higher, what I'm doing is I'm trailing my stop. So I'm removing risk on the original position, yes? And by removing risk on the original position, and it doesn't even need to be break even, it could be just halving the risk or even, just cutting it a bit. The moment I am able to do that, because what happens is my invalidation level for my whole idea moves exactly. What the majority of traders do, and this comes back to fear, is they are fearful of losing money. So they are fearful of being wrong, of having a negative experience, yes? So the first thing they do is put a stop to break even, and that's it. However, what I've come to learn is that the best traders, they know when to go big, when to size up. So as your idea is being confirmed, that what you're anticipating, and you're seeing the market literally tell to you one thing, hey, it's running, yes, I'm doing what you had outlined to do. What I'm doing is I'm adding and I'm adding and I'm adding and I'm trying to keep the same risk level.
So let me let's say counter this or throw another angle, which is I completely understand when you have a A+ setup, high conviction setup, and is given every confirmation that you need. Instead of doing your ordinary 1% risk, why not do 2 or 3? It's a good setup. Why would you not put more initial risk at the highest point in a sell where you have the most confirmation instead of trying to add more risk as it's going in towards profit, and as it comes back into the discount, at least let's say, there's a higher chance of reversal than it was right at the top. Why not add more risk initially as opposed to add risk along the way?
Very good question, and in my opinion that honestly depends on your trading style and your risk tolerance. And the reason why is because, think about it, right? A lot of people, they probably trade prop firms now. Well, good luck trying to risk 3% on a prop firm account. It's not going to pan out. So what you need to do is you need to manage your risk in a very tight manner, yes? So that's the first thing. But secondly, I'm of the opinion that yes, on swings, I'm able to risk sometimes up to 5% of the overall portfolio that I manage. What I do is when I see everything right, because it's going to be such a long period of time that I'm going to be in that move, I don't mind putting the capital there. However, when I'm trading on the short term, why would I be risking 5% if I'm a day trader and my frequency of trading is higher? You understand? So in my opinion, if you're a day trader, try to keep risk around 1 to 2% max, yes? And vary between there. So sometimes indeed go to 2%. But when you go to 2% for that idea, yes, what happens is, let's just use a simple example. Let's say you're managing a 100K account, yes? Personal capital, 100K account, you're risking $2,000. Okay, 2% risk, yes? Okay. What the majority of people look to do is they look to remove the risk completely. They look to, like, the moment that price runs a bit in their favor, they remove the risk, and then they're like, okay, now I can sit back and relax. What I am of the opinion of is the fact that the moment that price is signaling to you, hey, you're on site with the high frequency trading algorithms which are going to spool towards that objective which you had outlined, what you can do is you can look to maintain that same 2K risk, $2,000, whilst entering more and more contracts. So what I do is whenever I share my execution videos as well, where I literally showcase the full process from start to finish of any particular trade, what I do is I pyramid in there. And that right there is one of the most important lessons which I want to share as well. But pyramiding, and I'm going to put this out straight in front of you, you can only pyramid once you know what you're doing in the charts. Meaning, don't do this if you're completely new. Don't go into the charts and simply because you watch this podcast, next trading day think, oh, because you said this, I'm going to go out here and pyramid. No, you need to know exactly what you're looking for, and therefore your approach has to be objective. Until your trading approach is fully objective and there's no doubt about, okay, when to trade your stop loss, when that invalidation level moves, you shouldn't pyramid. However, when you're there and you know exactly, because that's the beauty, it's all fractal. Yes.
With the pyramiding, are you now allowing the time sequences that you mentioned as the reason to get in again and again?
Yes, exactly.
Okay, so can you connect the dots for me of how time sequences come in? Because my utilization of time is simply 2 key windows. I don't know if there's any specific magic in there, or is just a zone of increased volatility. An open of a session has more movement, and I'm happy to keep it like this. Whereas it seems like you have more moments within a day. So what are you doing that I'm not doing?
Yes. So first of all, there are a few key things that I'm doing, which I want to share on this podcast as well, which are the following. You're familiar with SMT.
Divergences.
What does SMT mean to you?
I'm seeing it on 2 highly correlated things, like an EU and a GU. When they should be. What
does it mean? SMT.
I see, in your lens, I don't know the way I'm looking at it.
That you're now explaining the theory, but I mean more so. What does SMT mean? The term. What's the name SMT? Because it's an acronym.
Not sure.
A lot of people got introduced to it as smart money tool or smart money technique. Yes, I'm sure you've heard those terms around. However, The T within SMT stands for something completely else. It's smart money time. So SMT is by far the most crucial element when it comes to my trading approach. Why? Because what SMT is signaling is that manipulation is coming to an end. So if I'm already anticipating manipulation to take place, yes, the SMT is signaling to me the manipulation is now going to come to an end. So SMT is a confirmation tool. It's not so much as, oh, you see SMT, therefore there's a trade, because that's the issue that gets now induced on social media, where you see all these guys, and especially ICT traders, and it's funny to see, right? You see these guys go online and they create like these schematics, right? And they say, okay, every single time there's SMT and a breaker forms or a fair value gap forms.
It's not enough. It's not enough.
It's really
the,
not
the
enough.
way I'm using the divergence, I just call it, is it's not even an entry criteria. It's I need everything else plus an entry criteria, and this is a cherry on top.
Exactly.
But I'm never leading with it.
Exactly.
But in the way you're doing it, where you're seeing the T as time, can you lead with it as an entry?
Well, that's the thing. Every single one of my entries has SMT on a way smaller scale. So, look, many people, they view SMT, they look at it from the lows and the highs. They just think, okay, SMT is there, boom, there we go, right? I can now just buy any fair value gap or whatsoever. However, if the audience would pay attention to SMT taking place inside of that smaller expansion, retracement lower, SMT on the lows, they're going to see something taking place that's, And just to shut up all the people that say, oh, buying and selling pressure markets are random whatsoever, how could you explain that the same framework, which I'm outlining to you right now, which is a reverse sequence, and if the audience is paying attention, they're already getting major steps to what it actually is. But what's important there, yes, is that it's fractal. So what fractality means is that it's applicable across all different time frames. There's absolutely no way, yes, that these markets could be random and that same repeatable logic is present. So if we would be looking at, for example, let's say a 1 minute market maker buy model, yes, on the Nasdaq futures, because that's where I'm focused on, the Nasdaq futures. If I would be trading that Nasdaq 1 minute market maker buy model, yes, I can be using a 5-second chart to trade smaller market maker buy models in sync with the bigger market maker buy model. And each one of those smaller market maker buy models is going to have the same steps.
Can you break down the time sequence?
Yes.
What are the windows of time or moments of time?
So when it comes to just intraday trading, let's keep it simple. I focus on macros. And what these windows of time are specific windows in which volatility is going to get ejected. It's not just an opening time, such as a Frankfurt or London Open. No, specific windows throughout the day in which we can anticipate volatility injections to take place. And what will happen during a macro is either an expansion or a reversal. And a reversal is a change in the state of delivery, where at first high-frequency trading algorithms were delivering price towards buy-side liquidity pools, so higher, higher, higher. And the change in state of delivery is where the opposing occurs, where sell-side delivery will take place, where the market will be drawn towards sell-side liquidity. But what's important to note is that when it comes to macro windows, ICT introduced them to the trading space from XX50 to XX10, yes, of every single hour, yes. However, what I do different is that I add 5 minutes to the beginning of that macro window and 5 minutes to the end of that macro window.
So it's XX minus 15 plus 15.
No. Wait, how do you... No, XX45. Yeah, you're right. Yes.
Okay. So you have a 30-minute window.
Yeah, but I'm sure that because I had to think about what you said. I'm sure some viewers are like, what did Wakar say?
Okay.
XX45 to XX15. If the audience is going to pay attention to everything which we have been discussing so far during that window of time, and it's fun because I'm not too sure if you could show that on the podcast, maybe edit it in, but it's now Thursday, and before I came to the podcast studio, I actually took a trade on Nasdaq. When did the trade took place? XX45 to XX15, 9:45 to 10:15.
And which hours are XX? Which hours would this apply to?
Every single hour. So now we're going to come back to SMT. What I'm looking for is a higher time frame SMT, because when I see that higher time frame SMT, that's setting up either a swing low or a swing high formation. And as that's taking place, I can anticipate, hey, that manipulation is now coming to an end. And what will follow is distribution.
How do you confirm when you have pretty much every hour a 30-minute slot? So when you add it up, out of 24 hours, you have 12 hours of tradable moments. How do you know which ones are worthwhile? Because then if the half the day is tradable, there's also plenty of lower probability moments or ability for human error and mistakes and so forth. How do you take it into more refined win rates?
Exactly. That's right there is where we start paying attention to time cycles. And what time cycles are something completely different than macros. There's a difference between time cycle and a macro. What time cycles are basically fixed windows of times that do not change. Yes? And I look at these from the bigger time cycles down to the smaller time cycles. And when it comes to time cycles, there are two things which can take place. As if a high gets taken out, we either see continuation above that high, or we see a reversal taking place. If we see a reversal taking place, what I'm looking for is the previous cycle low to be the draw on liquidity. Is that clear? So what I'm all the time waiting for is literally, okay, are we now taking out a previous cycle low if I'm bullish, and am I seeing the signs of a reversal taking place below that low, below that sell side liquidity pool? If that takes place during the right window of time, then I know that we're forming a smart money reversal there to deliver towards the opposing side of liquidity, which is buy side liquidity resting above the previous cycle high. But I know that that framework right there is already pretty complex, but just to give specific time windows that the viewers can start paying attention to, if you start paying attention to the following time windows each specific day, you're going to be looking at the charts from a completely different perspective. First of all, when it comes to the London session, I view London beginning, and all the times I'm going to mention are in New York time. Yeah, so it's important. This game, else people are going to be looking at their local time and they're going to be like, what's this? 2:30 a.m. is to me the beginning of the London session. Yes? I look at London from 2:30 a.m. to 7 a.m. in New York time. Yes? In that window of time, what I look for is 3 90-minute cycles. Yes?
Okay.
From 2:30 a.m. to 4 a.m. That's cycle number 1. And the characteristic of this cycle is to accumulate. So here we're going to come behind the why your setup works. Second cycle is from 4 a.m. to 5:30 a.m.
Just an hour and a half.
The function of this cycle is to manipulate.
Yes.
The third cycle is from 5:30 a.m. to 7 a.m. Yes? So you have 3 90-minute cycles which make up the London session. Yes? Next session, New York morning session, begins at 7 a.m. Yes? First 90-minute cycle, because we're going to be looking at 90-minute cycles again, and I know you're probably like, what are 90-minute cycles? Trust me when you start paying attention to where liquidity is being engineered, and more importantly, when you begin to see, aha, these time cycles play a huge role when it comes to when liquidity is being engineered. But first 90-minute cycle of New York morning session, 7 to 8:30 a.m. Second one from 8:30 a.m. to 10 a.m. Third one from 10 a.m. to 11:30 a.m. Yes? And each cycle has its own normal function. Yes? So 7 to 8:30 accumulate, 8:30 to 10 manipulate, 10 to 11:30 distribute. Yes? And when you look at the economic calendar, it makes sense why all high impact news releases either take place at 8:30 a.m. or 10 o'clock. And that's something else to speak about later. And then for the afternoon session, it's the same logic, but then from 11:30 a.m. to 4 p.m. And what I'm looking for all the time is I'm looking for that what I just outlined, where it's a purge and refer taking place, where I see that we take out a previous cycle high if I'm bearish, and we see the signs of reversal taking place. If the higher time from order flow is bearish, that's a key insight there. If that takes place, then I can anticipate the price is going to draw towards the opposing side of liquidity. So what I've just given to the audience, if they're paying attention, and I'm sure that some people are probably listening and they're like, this is pretty complex stuff. Yeah, it is complex. If you thought that this would just be a walk in the park, you're in the wrong business, my friend. And the thing is, that's something which really frustrates me about all of these trading guys online nowadays, is they make it look so simple. They make it look so damn simple, is that if you're just trading this pattern, there you go. No, the way that my mind is structured, and that's why I noticed that we're a bit different, where you don't mind not knowing the why, but I do. And I want to know the ins and outs.
You know the difference is because you mentioned earlier, and I wanted to touch on it. My philosophy, I have mantras that I write down and I repeat to myself. One of them being, I don't predict, I react. Because I'm not in the business of knowing where price is likely to go. But when the market shows me its hand, I react towards that. I don't predict what's going to happen. But if I'm to speculate, I would say if I understood the whys, which if that's an achievable goal, then I can start to predict, which is probably the lens you're coming from.
I love that you're saying that. You're seeing me smile as well, because for me, my mantra or my motto is, I draw lines and predict the future. That's it. And the reason why I say that is because of the fact that I've objectified my whole trading approach from a time and price perspective. And when I see exactly what these high-frequency trading algorithms are coded to do, are scheduled to do, based upon a time-based delivery schedule, yes? And I see step 1 to 6 taking place, there's no ambiguity behind what step 7 is going to be.
So let's get into the why, because this is an area I have a gap in knowledge. I don't know why. I observe it, and I can vouch for it at times, but I don't know why is time important when it comes to delivery and price.
Very good question. Sorry, just taking a sip of water. We're speaking a lot, of course. But when it comes to the importance of time, look at it from a coding perspective, yes? There are multiple variables which you require in order to code an algorithm. And in order to code an objective algorithm, what you must first be paying attention to is when is the algorithm going to refer to the following if this then that statements. Because that's what it all comes down to. If this, then that. And when you recognize that if this, then that sequence for enough steps, then you can anticipate what the next step is logically going to be. So the timing element is when the if this, then that statements in price are going to be looked at. If the time isn't right, I don't care about what's happening in price. And that right there is, in my opinion, what is keeping so many traders back, where they're simply just looking at trading random price patterns whenever they appear and they don't pay attention to the x-axis. But that right there was for me a complete game changer once I started to pay attention to time. And that is also why I think that when I came across trading at first, I began just as everyone else begins, right? You know, you get sucked into the lifestyle marketing, you get sucked into, you know, these price patterns, you just trade this price pattern and you're going to be a millionaire overnight, right? That's the image that has been created, which is completely false. But because I got sucked into it that way and I found out the hard way that it didn't work that way, eventually, I came across ICT's channel. And once I saw ICT objectify the whole process from making an analysis to actually executing from a time and price perspective, that's when I began to realize, hey, this particular price pattern only holds any weight when it's occurring at the right time. And there are multiple ways of looking at time, because when it comes back to those time cycles, which I explained prior, I know a lot of viewers are going to be looking at the time cycles if I explained them, and they're going to be looking at them through the lens of, oh, okay, so between 8:30 to 10, every single day there's going to be manipulation. No, that's not how it works. And the reason why it doesn't work that way is because time cycles shift, meaning their function shifts. So when we bring it back to the beginning of this conversation, when I said I focus on recognizing manipulation, which you can recognize very clearly when a specific open manipulates towards the downside into a key level where you're anticipating reverse to take place from, you know, hey, we're manipulating now during this time cycle, next time cycle is going to distribute, yes? But what's important to note is that what for me was a complete game change is just paying attention to the x-axis. When is it taking place?
As a trader, it's very simple. You have to find an edge and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it. And probably you'll be using it for years to come.
Just to qualify the when, what would be your preferred key level? So you found your appropriate time window, let's say the manipulation 90-minute window and the moments that you'll execute upon. Where would you ideally want price to be? What kind of a key level? Just so people can know, okay, I'm not going to understand all of it today, but where can I start off with?
Just paying attention to the time cycle's liquidity is all I'll suggest the viewer to do. And the reason why is because if I would share more in that sense about that, I would disrespect Michael's legacy, first of all, because there's a reason why he hid these things in his logo, etc., and why he kept the true meaning behind his logo a secret. Because there's...
You want to elaborate on that?
Yeah, the thing is, ICT mentioned this multiple times in his lectures and on a podcast appearance, which he did as well. But within his logo, within the circles, there are numbers which are visible. And once you recognize what those numbers are, you know what key levels price is going to refer to. And
Okay.
with
Hidden in plain sight.
with exactly hidden in plain sight. And in my opinion, that right there is probably one of the craziest things to do with his audience, where now I believe he's approaching 2 million subs. Everyone is overlooking something which he has hidden in plain sight. And that right there is, in my opinion, what changed the game.
Okay, so there's a lot of dots I've connected now in this conversation. The key levels, the time sequences, the accumulation, manipulation, distribution. The portion I want to focus upon now is, let's say I've arrived to a key level and it's the appropriate time and I'm looking for a reversal. What do I need to see in that moment in time on a lower time frame to go from an invalid entry versus, okay, I'm seeing the rejection I need, I can execute on this zone?
That's a very good question. And then we're speaking about changing the state of delivery. That's where the focus is there on, where we are focusing, okay, how can we confirm the change from sell program to buy program or from buy program to sell program? When it comes to CSD, because that's the acronym for it, and the reason why we use acronym within our conversation is because it's just easier to explain.
CSD being change of state of
Yeah,
delivery. Okay.
the full acronym doesn't make that much sense because there are more
Understood, yeah.
letters, but CSD stands for change in state of delivery. And when it comes to CSD, what's important to note is that the easiest way, in my opinion, to look at CSD is by paying attention. Okay, let's say that we're looking at the bullish example, you're anticipating higher prices. What's happening there is that you look for manipulation towards the downside and you look for the market to drop. Yes? As the market is dropping, what's being created are imbalances or bearish value gaps. I think that's the term you use, right? Bearish value gaps are being created. The moment that those bearish value gaps begin to get validated, so price begins to run through them, we can see that the order flow is changing from sell program to buy program. But here comes the thing. Nowadays, there are a lot of traders online that speak about inversions of value gaps, where you can utilize that bearish value gap as support and price on the right side of the curve. You can trade off it. And they treat every single bearish value gap which gets traded through as if that is the case. However, that...
So basically, you take a fair value gap, you buy it, and if that fails, then you use that to sell it.
No, that's not what I'm saying.
Okay.
Because that's
I mean, that's how people are using it.
Yeah, that's how
The
people are
inverted
using
version,
it,
okay.
but that's how I'm saying not to use it.
Yeah.
What I'm saying is that if you are anticipating a swing low formation to take place, because you're bullish, because price manipulated in your point of interest, yes, you know it's going to draw towards the upside. You have everything defined, and you see everything occurring as it should be occurring at the right timeline in a sequence of events. And you begin to see those bearish value gaps get displaced above. From that moment in time, you know that their function is changing, where instead of them functioning as resistance on price to draw price even lower, what will happen is that the longs will be filled inside of those specific price ranges. And what will then happen is that the underlying program will change from sell to buy program. That's one way of defining CSD, which is, in my opinion, physically the easiest thing to do. However, to give the viewers a more of a deeper approach, which is what I'm initially known for within the whole ICT trading space, is the market structure shift pattern. And I promise, Wakar, if you start looking for this market structure shift pattern at trades which you have previously taken, each one of them that you've taken had this pattern inside of it. And if it isn't inside of the time frame that you're looking currently through the chart set, yes, it's on the lower time frame. But every single reversal has this pattern. So for me, it is the number one pattern I'm looking for all the time. And what it is the following. If we take it back to that imbalance, which formed whilst the market was dropping, and we see a low take place, a small little low forms, and we see a retracement into that fair value gap taking place, what I'm looking for is one more push lower into that key level. Why? Because it's exactly in that push lower that manipulation is taking place, where sales liquidity is being taken out, which has been engineered below that low, which set that retracement higher. And when price then displaces through that high, which set up that final run towards the downside, and it displaces above that bearish value gap, and here comes the most important part, and this is what you need to start paying attention to, a bullish value gap gets created. So you have a bearish value gap high inside of that bearish value gap, bullish value gap through that high. The moment price retraces into that range, I'm buying it. Why? Because the price range is being balanced out. And yeah, not make it more technical than it already is. Balanced price ranges are the whole reason why price is moving up and down. And that's what I'm looking at.
I'm curious to know your thoughts on this idea of where, with the years you've had in the market and the knowledge that you have, you're approaching a level of mastery where you're understanding many components, and probably you're understanding so many things that you're not even trading. You're just observing it, and you're just like, okay, these don't meet my criteria, but I can predict, I can watch. Do you think that level is needed, or is it enough to just find 2 or 3 high quality objective setups that appear on a regular frequency? And you could take 3 trades, 4 trades a month, all of them high quality, and then you can ignore the rest. So therefore you are waiting or recognizing the patterns that were, the context that you need, as opposed to trying to understand every day, every moment.
That's a very interesting question. And that is something which I struggled with answering for myself for a long time as well. And the reason why is because I can predict every single price swing as it's securing throughout the day. So when I came to that level of knowledge and I understood exactly, hey, this is how IC is actually trading and this is what he's using from a time and price perspective, I became very good at predicting price swings. However, where the hard part for me was where do you draw the line? Where do you say to yourself, hey...
What do you trade?
Yes, exactly. But also, where is enough enough? You understand what I'm getting at? Where are you content with enough? Because the issue I was facing was that all of a sudden, trading wasn't just, hey, I'm here to make money, make ends meet, and that's it. No, trading was the source for me to feel a sense of fulfillment. Be right, be right, be right, be right, be right. Do you understand what I'm getting at? So this is a very common issue that I see with a lot of new traders, especially the ones that are diving very deep and that are becoming very good, is that they don't know where to draw the line and where to become content with enough. And therefore, I would like to ask the question to those individuals which are listening to me speak now and they're like, hey, I feel that. Look, I want to ask you a question. Are you trading to live? So are you using trading as a vehicle to fund a specific lifestyle, or are you living to trade? Are you basically waking up each day and the only thing on your mind is the markets? And that right there is where I think there's a very important choice that every new trader has to make, where they realize, hey, by doing less, I'm actually able to return more because the setups which you're taking are higher quality. But in order to do that, you must actually live your life. As weird as it may sound, you need to have a fun life. You need to have hobbies that you engage in. You need to have quality time with your friends and family. And you just need to live life. And as you start to have those natural sources of dopamine, what will happen is that it will be easier to do the right thing. However, when you define your self-image based upon, hey, how good you're performing within the markets, that's a very toxic cycle which you can be stuck in. Do you understand what I'm getting at? So that's a very good question which you asked, and I really appreciate you asking it.
The phrasing you used was when is enough, and the undertones of this is like you have a choice of like
exactly.
I can either make 100K or I can make 200K. But the reality for most traders is I take what I can get, like whatever the market gives me based on my strategy, how it performed. Do you think that's an incorrect lens?
Yes, and there's a reason why that lens has been created and why that mindset is being induced in every single new upcoming trader. And the reason why is because what they want is they want traders to trade. They want traders to push it. That's why prop firms are saying those type of things. Why? Because they want frequency. They need frequency, yes? So all the trading education is all about frequency. You need to trade as what the market provides. You need to trade when the setups appears, this and that. Well, let me tell you something. If you purely trade based on price patterns, which I know the majority of audience still does, which has to be changed, but if that is the case, you're going to be taking tens of trades a day. Why? Because the price pattern is there all the time. You can always look for it. However, when you start looking at that from the perspective of, okay, you know what? I'm here to make money, and once I make my money, I'm done. I'm going to live my life. What will happen is that you're going to experience way more peace of mind. You're going to feel way more fulfilled in that sense. So I think that that's a very important choice that every single new upcoming trader has to make, that they realize, hey, trading is just one avenue which you can pursue in your life, one hobby. It's your business, yes, you need to extract money from the markets, but it's not where you get your feeling of joy. When I sit in front of the charge car, honestly, I don't get any dopamine spikes. I don't get any like, oh, yes, look, I just made so much money today. look, this and that, whatever. And yeah, I'm just dead inside. And I think that's the mindset which is required.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and NinjaTrader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader.
The majority of the episode we've been speaking about trade ideas, entries, how we predict. But and a lot of traders overlook the exit. So I want to spend the last portion of the podcast speaking about how to get out. And I'm going to maybe forecast your answer. Is it going to be based on time? Is it going to be based on the levels? Or is it based on just risk to reward profiles?
Risk to reward profiles, first of all, to me mean nothing. And the reason why is because I believe that risk to reward is a variable which is dynamic. And that means it changes. I don't use fixed 1 to 2. I don't use fixed 1 to 3. I don't use fixed 1 to 4 whatsoever. No, my risk to reward changes. And the reason...
Because you're scaling in, the pyramiding, you mean?
No, because every single setup which I take can be a different setup. If I'm entering at the low of day, I would be foolish to go to that 1 to 3 if I know the low of day is where I'm entering. You understand what I'm getting at? If I enter around 9:45 and I know I'm buying a low of day and I anticipate the whole remainder of the day to distribute higher, I'm going to be leaving runners. And I'm going to be leaving runners until close at 4 p.m. But the majority of the position, of course, gets taken out at the high of that original consolidation when that market maker buy model completes. Okay? So risk to reward to me, yes, it's nothing. It's a variable which is dynamic based upon the analysis which I've made. How far do I anticipate that price is going to be spooled? How high is it going to go? Or how low is it going to go if I'm looking for sells? Next that, when it comes to the exiting strategy which I apply, it's exactly the same framework, but then in first. So the framework which I utilize to get into the position at first is also the framework which I'm going to be utilizing to get out of the position.
Okay, got it.
Do you understand
You're
what I'm getting
waiting
at?
for a accumulation, manipulation, distribution the other way around, counter to your position.
No, the reversal sequence. That's it. I look for reversals again and again and again and again. So when I recognize the price reaches my draw liquidity, my target, yes, and I see the signs taking place of a reversal taking place, I look to scale out. Why? Because...
Okay, you don't exit on the key level. You arrive to the level and then watch and see if you're getting a reversal.
No, that's a good question. It honestly depends on inter-market relationship. So what I'm actively monitoring all the time is I'm monitoring, okay, are the three indices, Nasdaq, ES, Dow Jones, are they moving in tandem with each other? If they all cross the level at the same time, then I know, okay, I can leave it running. Why? Because they're all doing the same thing. However, if only one of those three indices, and it's important to note that what I'm explaining here is applicable to all markets, even for crypto traders. If you're trading Bitcoin, ETH, use the same logic. It's all the same. All I'm paying attention to is, okay, at what moment in time does market one take out that time-based high? And the element of time is again coming back, yes? So it's the time cycle high which I'm referring to. If market one takes out that high whilst market two is not even close, then that's SMT between the time cycle. And all the SMTs which I'm looking for, Wakar, are all time cycle SMTs. And because, yeah, and I know this is, you know, it's funny always, if I, you know, create a lecture or something or a trade breakdown, I can see it in the stats, right? You can see it as well for your podcast, how many people actually stay in the video, what's the retention rate, etc. You always see a drop, right? And I utilize that drop to filter out all the weak-minded individuals because I know how many hours I had to put in at a very young age and how much dedication I had to put in to get to this level of understanding. And now I appreciate as well why ICT was creating all these long lectures, because he was filtering out the weak-minded individuals. He was keeping all of this basically only for a small group of individuals that were willing to put in the required time and effort. Yes? So since we're now
at the end,
further in the pot indeed, speak a bit more about, you know, some deeper insights. SMT, yes, that divergence which you're speaking about, it's not just any divergence. It's not just, oh, there's a divergence and therefore there's a trade. No, it's a divergence relative to a time cycle high or low. Those are the only SMTs that matter. So for example, if I see that we are bullish, and this week is a beautiful example of the time of the recording. It's the end of July, Nasdaq is near new all-time highs. What happened this week? Well, over the weekend there was a lot of fear about the war. I'm not going to mention anything on that, but what happened? We open up the week. What happened? Nasdaq ES take out the previous week's low. Yes. Dow Jones doesn't take that previous week's low. Reach a key level, and what happens? Huge expansion higher. So do you see that it's not just, oh, it's a cracking correlation on the lows and therefore running higher. No, it's a cracking correlation relative to the previous week's low, which is a big time cycle. So the viewers need to start paying attention to SMT, not only through the lens of, oh, there's a divergence and boom, there we go. No.
So where and when as well.
Exactly. Relative to what time-based liquidity pool. So and that's fun as well. You have all these SMT indicators. I'm sure you've seen them around in trading view, right? Mm-hmm. You have all these, like, oh, there's a divergence here or divergence there, etc. And you have hundreds of divergences throughout the day. Yeah, you tell me which one is the one that matters. I've just given the answer. The time cycle SMT is the only SMT that matters.
Okay, the last question I want to ask you, and as you mentioned, you laid me up for this, so this is your fault. We're at the end of the episode, less people are watching, the more deserving are watching because they're putting in the effort to stick around. What is something that you know that you probably didn't want to share, but now you've been invited to share it?
Technically or psychologically?
Something you've learned in the years of ICT, the long hours you've put in, something that is hidden in plain sight, something that the average ICT trader probably isn't even aware of. What is something that the viewers that made it to the end deserve to know?
Well, first of all, if you watch this podcast all the way to the end, I want to congratulate you because I know I spoke a lot and some of you are probably sick of my voice or whatsoever. But when you start paying attention to everything which I outlined during this podcast, and I want to thank you, Wakar, because subconsciously you actually revealed everything in the right order of events, the topics which we spoke about. I'm not able to gauge whether or not you know it as objective as I do, or if
maybe
it's just,
not. I don't know.
if it's just meant to be. But if you would watch this podcast from start to finish, and you would pay attention to in what order of events we spoke about certain topics, you'll be able to see that there's a specific sequence which I label the reversal sequence, which is completely objective, that's occurring again and again and again and again. And once you start to see that within price, you're going to be looking around the room and you're going to be thinking, when's the FBI going to come? That's how it felt for me. And ICT mentioned it would feel like that once you start to see these things, right? Where you're fearful because you're thinking to yourself, should I know this? Well, what's going on right here, right? That feeling where you're fearful, where you're thinking about, hey, is this something which I'm supposed to know? Understand that right there is one of the most beautiful feelings to have, and cherish that, because I wish I could go back in time and experience those moments again, where I was experiencing all these different light bulb moments as I was trying to figure out why is this happening in this specific order. And I think that right there is one of the most beautiful things to experience, Wakar, where you begin to know, hey, this is my model, this is my trading protocol, and you don't care about anything else. And once you find your model, once you find your edge, only stick to that. So don't look around on social media and think to yourself, oh, this person detected that trade and you weren't in it. Oh, I should have taken that or whatsoever. Define your protocol, define your model, and once you have it, stick to it. And there's this one saying which I love to say, and it's KISS. Keep it stupid simple. So what I've done is I've literally explained during this podcast a very advanced system, yes? There are trillions of dollars that are being moved around daily utilizing the system, but we broke it down to a simplistic approach that you can visually see. And I think that's something that the viewers can study, man.
Beautiful, bro. I think the summarizing statement therefore at the end is, once you see it, you can't unsee it.
Yes.
I think that's basically what you're explaining.
Once you see it, you can't unsee it, and cherish that feeling and understand that it was meant to be. It was meant for you to see this. And once you appreciate that as well, treat it accordingly. So don't go out there and try and show off, use it for the wrong reasons. No, just do it to provide for you and your loved ones. Make sure that the intention that you're working with, that you're waking up each day and that you're getting after it each day is pure and it comes from your heart, and not to fulfill an ego or a status side of things.
My man, what an episode. That was a
sure.
deep dive, but thank you, Frank. That was Zeussy.
Thank you very much
Pleasure,
for having
bro.
me, brother.
There we go.
We
There we go.
appreciate you,
Good
brother.
stuff,
Thank
my man.
you.